Good afternoon, everyone. Before we get started, please know that this webinar is being recorded and we will post a replay to our website, evansmay.com, and that will be available through the end of January. So thank you to all of our clients who have submitted questions in advance. Please know, as we typically do, if you have any questions during the webinar, please submit them using the Q&A feature that you can find by hovering over the bottom of your Zoom video window. And our plan is Lizanne and I will discuss, I'll pose various questions for about the next 45 minutes, and then we'll leave 15 minutes for Q&A at the end. So let's get started. Thank you again for everyone who's joining us today. This always promises to be an insightful and engaging discussion, and we are so honored to have Lizanne Sonders, the Chief Investment Strategist at Charles Schwab, with us. Many of you know her. She is world-renowned for her expertise in market and economic analysis. Her list of accolades is long. Her career has spanned for more than 3 decades. You've seen her on every CNBC, every major media outlet. And I think one of my favorites is she is consistently named as one of Barron's top 100 most influential women in finance. So our plan today is to talk about the current market landscape, economic trends, and investment strategies for the future. So with that, please join me in welcoming Lizanne Sonders.
Thank you so much. Hi, everybody. So nice to be here.
So let's get started. Let's start first with the economy. So share with us your latest thinking on where we are going in this unique economic cycle. We have a lot of questions, especially what that means in the aftermath of the election. So we'd love your thoughts.
Sure. So it has been a unique cycle, and I don't want to rehash the last, call it 4.5 years, but just to put it in sort of the pandemic context, I think the reason why we have to look at this cycle in a unique way is because of the characteristics of the pandemic and how that led to a very different cycle. So if you think about the early part of the pandemic, especially when things started opening back up and the stimulus kicked in, all of that demand was forced to be funneled into the, call it the goods side of the economy, because as we all remember, services were shut down for quite some time. That was where we saw the initial surge in growth. That was where the inflation problem first began, is in those goods categories. But then subsequently, we went into pent down demand on the goods side. We actually went into recessions in areas like manufacturing and housing. It didn't take the entire economy down with it, but we had sectoral recessions. We've just had the later offsetting strength on the services side. And services is a larger employer. That helps to explain just how resilient the labor market has been. That helps to explain in turn how resilient consumer spending has been, even though savings per the stimulus era have been drawn down. It also explains why inflation has been somewhat slow to come fully down, to erase the big inflation surge that peaked in 2022. Even right now, if you categorize inflation, a metric like the consumer price index, and you separate it into the goods categories versus the services categories, the goods categories are actually almost in deflation territory, where you've got declining prices, where the services categories are still in 4 or 5% inflation levels. So we continue to have these bifurcations. And in terms of where we sit right now, there have been lots of cross currents. We had some weaker employment data last summer that led the Fed to step up and start cutting interest rates. But that weakness in employment was very short-lived. And even though the Fed cut the Fed funds rate by a full percentage point, during that same span, longer-term bond yields have gone up by more than a full percentage point. So the latter kind of reflected this ongoing resilience in the economy, and that's part of the reason why the Fed went from being in easing policy mode, now arguably in sort of pause mode, wait and see. And of course, we have the policy-related uncertainty of the government variety that I'm sure we'll talk about as well.
Yeah, that's a great segue into the next question. So there is, as you mentioned, increasing uncertainty as the path to rates and rate cuts from here in light of the strong labor market. So what are your expectations for monetary policy for 2025? Do you think we will see no cuts this year? Or what does that path look like going forward?
So I think the Fed's desire is to continue to cut rates at some point. I think the data suggests that now is a time to be in pause mode. I think to try to assess how many rate cuts when they start is a bit of a fool's errand because we're dealing with a Fed that's very data dependent. So tell me what the data is going to look like, and I might be able to tell you, will they cut rates this year? When will the first new, rate cut happen in 2025? It's funny in the immediate aftermath of the release today of the consumer price index, you did see a number of economists and Fed watchers come out and make adjustments. I heard one say, okay, instead of starting to cut again in September, that's moved back to June, or instead of cutting in July, that's moved back to June. And I thought to myself, boy, there's a heck of a lot of inflation data and employment data over the next 6 months. It's sort of, finger in the wind at this point. But that's the nature of things like the betting markets. The probabilities right now are that the Fed doesn't do anything with rates at the January meeting. I think pretty decent likelihood that they don't do anything at the March meeting too. But there's so much uncertainty with regard to government policy, particularly on tariffs and immigration at the outset of the new administration. And even the Fed is starting to reflect some of that uncertainty in their commentary. And the one thing we can say, all else equal, is that if the administration decides to go to the extremes of what was proposed from both the tariffs and immigration standpoint, again, all else equal, that probably puts some downward pressure on growth and some upward pressure on inflation. And once that actually kicks in, that's something the Fed is going to have to take into consideration too. So a data dependent Fed, given all the unknowns, the known unknowns, including policy, means that it's really difficult to say what the next move will be by the Fed, other than pretty likely scenario of not doing anything at this month's meeting.
And what's your opinion as it relates to the new administration's take or what they're forecasting on post tariffs and immigration policy as it relates to growth and inflation? I think that's certainly the um, billion-dollar question.
Yeah.
But do you think it's more of a negotiation tactic, or what? How do you think that plays out?
There's lots of views out there, and I hear them expressed all the time. And quite frankly, I think every time I hear somebody say, "Oh, it's just a negotiating tactic," that isn't part of the administration, I think, how do you know?
Right.
It's pure speculation. I have no idea. What we can do is we certainly can't rip all the pages from the 2018 playbook and apply them to the current environment because there's so much different. There are a lot more differences than there are similarities, not least being the fact that 2018, as a reminder, was pre-pandemic. So we were in a very different inflation backdrop in 2018 than we are right now. So that alone means the assessment is different. But maybe the page we can potentially pull from the 2018 playbook is the manner by which many of the announcements around trade get made, often via social media postings. And so that's the tricky part of trying to gauge this. What we do hear from inside the circles in Washington, and I have a colleague, Mike Townsend, who is our chief Washington kind of policy guru, does expect that you'll get some details on executive orders immediately after inauguration. So we don't have too much longer to wait. But regardless of what your views are on Trump, whether you're more in the hatred camp or the love camp, there is generally agreement that he's unpredictable. So I think that's the most relevant page to pull from the 2018 playbook. And then on top of that, what also makes this backdrop different is what's being commensurately proposed on the immigration front. And leaving aside the politics of it and the legal versus illegal, I get all that, but purely from a how does this impact the economy? We have to remember at its base level, GDP is a function of productivity and labor force growth. And in the case of labor force growth, even though United States demographics are not great, better than a lot of other places around the world, better than China, better than Japan, better than a large swath of Europe, we have benefited in terms of increasing that supply of labor, especially when demand for labor has been so high via immigration. So it has to come into the mix too in terms of assessing the impact on things like inflation, because less labor supply, all else equal, puts upward pressure on the costs of labor. And that can also feed into inflation. So we're all in wait and see mode, and I'm not foolish enough to say they're going to be reversed right away, or it's just a negotiating tactic, or he'll never go there. I have no idea.
That's very fair. Okay, so moving away from the inauguration and Trump's proposed policies, let's talk about the yield curve. So we've had some clients ask us why tried and true indicators like an inversion of the yield curve and leading economic indicators have not led to a recession yet, or is that to come? So tell us your opinion on that.
So, it's right to mention those two specifically, because although economists and strategists look at myriad indicators to gauge where we are in the economic cycle, where we are in the market cycle, probably two of the tried and true indicators of recession or recession risk being elevated would be an inversion of the yield curve. So I'm guessing most clients know what that is, but because it only takes like 20 seconds to explain it,
Yeah,
I will,
please.
just in case people are thinking, what the heck is she talking about?
Yeah.
So the normal yield curve is a function of shorter term interest rates. So the Fed funds rate that the Fed sets, or 3-month Treasury bill yield, or a 1-year Treasury bill yield. Normally those yields are lower than longer term yields. So say a 10-year Treasury yield. That's a normal yield curve. It allows financial institutions and banks to borrow at low interest rates and then lend out at higher interest rates, thereby giving them a profit and making lending accessible and broader. The opposite happens, of course, when longer term interest rates are below shorter term interest rates. And that can come either because growth starts to slow and interest rates come down, or the Fed is raising short-term interest rates aggressively, and then say the 10-year yield starts to think about the implications that higher interest rate backdrop is going to have for the economy. Longer term yields drop and you get an inversion. And it has been a pretty consistent indicator of recession, with lots of variability, though, in terms of the lead time from an inversion to a recession. In fact, what a lot of people don't realize is it's not really the inversion that sends the warning about a recession. It's going from inversion back into positive territory. So you can almost use a weather analogy. The inversion is sort of the watch, and the uninversion is the warning. So there is a lot that's different this time, and I'll answer more directly why this aggressive tightening cycle by the Fed until recently didn't have the negative impact on the economy. But I think to say it's a dead indicator, nothing to see here, no recession risk as far as the eye can see, I think you have to be careful about extrapolating that too far into the future. Now, one of the reasons why the move up in interest rates when the Fed was hiking interest rates didn't have the negative impact on the economy is two very important related reasons. There's sort of three constituents in the economy. You've got the government constituency, you've got corporate America, and you've got individuals, households, consumers, homeowners. Well, leaving aside the government sector, which probably should have done more when rates were low, what the corporate sector did, particularly larger companies, was something called they termed out their debt. When interest rates were incredibly low, when the Fed had the Fed funds rate at 0, when the 10-year yield dropped to as low as 0.5%, a lot of companies took advantage of that. They lengthened duration, they locked in these incredibly low rates. And as a result, even when the Fed was raising interest rates, many of the large companies were and still are earning more interest on their cash than they're paying interest on their debt. So it's actually been a boom to many larger companies. A lot of homeowners did the exact same thing. They termed out their debt. They moved from variable rate mortgages to fixed rate mortgages. That's why at the peak in the mortgage rate, which was close to 8%, at that same time, the actual effective mortgage rate held by homeowners was about 3.8%. So you just had this dampening influence on the economy with this aggressive tightening cycle because of what a lot of borrowers did during the part of the cycle that preceded it. And then in terms of the leading economic indicators, so there is one index that is widely tracked. It's the LEI for short. It's the leading economic index. It's put out monthly by the Conference Board. And that has been in kind of recession watch territory for a couple of years and obviously has not led to a full-blown recession. But as I already mentioned, we did have a housing recession from which we're still starting to recover. We did have a manufacturing recession from which we're still starting to recover. So it did pick up weakness in those very cyclical areas. We just had the later offsetting strength in services. So the normal course of things is you start to see a tightening in financial conditions, then it ultimately impacts the manufacturing, more cyclical part of the economy, and then it eventually works its way into the services side of the economy. So the LEI picked up the weakening in financial conditions, the manufacturing, housing type recession. We just have had at least this elongated span between weakness in manufacturing and when it started to show up in services. We may eventually get it, but we also may get to a point where services maybe has its day in the clouds, to butcher, I guess, an analogy. But at a time where maybe we've started to see recovery in those areas that already had their contractions, already had their hard landing. So yet another way to think about this cycle in a unique way.
Thank you. Let's shift and talk about the federal deficit and debt. So we have a lot of investors, a lot of clients, and I think investors overall increasingly concerned about the size of the federal deficit and debt. So do you foresee any kind of tipping point ahead?
So, when I get that question a lot, when is the what going to hit the fan or a tipping point? And that often, if you probe a little more with a question, different answers come out of posing that question, but it's usually something around at what point does it really start to matter? Meaning, an assumption that we're going to get some huge spike in long-term interest rates because the bond market has to offer much higher yields in order to entice people to buy treasuries, which is how we finance our deficit. I don't view the problem as being prospective at some moment in time that is going to represent some crescendo. There's a lot of things that are unique about the United States. Obviously, its size, its economic power, but the fact that we have by far the largest and deepest and most liquid bond market via the US Treasury market, the fact that 80% of world trade on one side of the transaction or the other is still done in US dollars. So there continues to be ample demand for buying treasuries. We have the world's most powerful central bank that, to use very simple terms, can print money. So I don't worry about some moment in time crisis, either in terms of a spike in bond yields or a spike in inflation or a default by the United States Treasury. Don't see those as in the card. But the problem of a high and rising burden of debt that comes from having annual budget deficits that continue to be significant is it puts downward pressure on economic growth and many of the component parts thereof. And that has been going on for some time. And that's also not just a US phenomenon, that's a global phenomenon. The real kind of solution to this problem is not a moment in time solution. It's getting to a point where the growth rate of the economy exceeds the growth rate of debt, because then you start chipping away at the problem. Unfortunately, I think the investor class cares deeply about this topic. It is the number one question I get at client events. I think the average voter may care about it in the abstract, but they don't tend to vote based on it. And that's why, leaving aside things like, the Musk, Ramaswamy, Doge efforts that will soon be underway, there haven't been a lot of adult conversations in the proverbial room in DC about this problem. And I say that in a bipartisan way, because it
Right.
didn't occur much under Biden, it didn't occur much under Trump, it didn't occur much under Obama. So this is not a partisan comment. It just sort of is what it is. And it's in part because voters aren't voting based on it. Now, as far as what can be done about it in the short term, Musk had said, hey, there's $2 trillion worth of cuts that we can find. He has already backed down off of that and said that's maybe was a little bit unrealistic. There is a lot that can be cut, but if you are not going to touch entitlements, that sort of non-discretionary spending, you'd have to cut pretty much everything to the bone. And so the reality is going to be something a bit watered down than what was proposed. And it might move the needle a bit, but it's nothing resembling sort of a solution to this problem. There's no moment in time solution to this problem other than reversing that relationship between the growth rate in debt and the growth rate in the economy.
That's good. That's so true. Okay, this great moderation era of 2+ decades leading to the pandemic, is that over? And if so, what does this new era of investment look like?
Yeah, so for people not familiar with what that era represents, and the term was coined. Sometimes former Fed Chair Ben Bernanke gets credited with coming up with that term. Sometimes former Treasury Secretary Larry Summers gets credit with it. Maybe that piece doesn't matter, but that's the genesis of where we started to hear it. But it basically covers the period from the mid to late 1990s through the early part, call it the first year or two of the pandemic. And part of the reason for that moniker is that it was a period of moderation. We had very little inflation through that period of time. As a result, we had a very benign interest rate environment, generally declining interest rates, those set by the market, so treasury yields almost the entire period of time. We had massive globalization that had the effect of keeping inflation down. That was driven in large part by China joining the World Trade Organization in 2001 and basically flooding the world with cheap and abundant access to goods and labor. Well, fast forward to where we are right now, a lot of those ships have sailed. We have more economic volatility. We have at least more inflation volatility. That's not the same thing as saying inflation is high, it's never coming down, it's going to be high in perpetuity. But just more inflation volatility, or at least more inflation uncertainty. We also have, and I wouldn't term it as deglobalization, but clearly a lot more protectionism by countries all over the map, and a focus on some reshoring, but also just supply chain diversification. That was one of the lessons learned during the worst part of the pandemic, is we need to have more diversified supply chains because of the bottlenecks that occurred when we had something like the pandemic. China is no longer the world's low-cost provider of labor or manufactured goods. That's been spread out around the globe a bit more. So what we think that means is that we're in a different secular environment, and it may look a little bit more like, though not a lot alike, the 30 years that preceded the Great Moderation. We've been calling it the temperamental era. So the period from the mid-1960s to the mid-1990s. And maybe the most important difference between those two eras that is most relevant to investors is that during almost all of the Great Moderation era, bond yields and stock prices moved in the same direction. And that's because inflation wasn't a big problem. So if bond yields were going up during the Great Moderation, it was typically because growth was improving, not because we had an inflation scare. That's great for the equity market. Vice versa, when bond yields were going down, it was typically because growth was weakening, we were potentially heading into a recession, negative for the equity market. The complete opposite was the case for almost that entire 30-year period that preceded it. Bond yields and stock prices went in the opposite direction, because when bond yields were rising in that environment, it was typically because inflation was reigniting, not just because growth was improving. That's a pretty toxic environment for the equity market. Vice versa, when yields were coming down, it was typically because inflation was receding, good for the equity market. We're back in that negative correlation territory right now, like we were for that 30-year span. It's not a long enough span to say, see there, that's the proof statement for us being in a secular era. It's more of this is a key metric or relationship to watch as a signal of the likelihood that we're in a different secular, longer term macro backdrop.
That's good. That's and especially relevant given what we've seen yields do here recently. Well,
yeah, we're certainly living that recently with
right.
a big move up in yields corresponding to a somewhat meaningful pullback in equities, notwithstanding the strength today since early December. So we're certainly seeing that relationship hold just in the last couple of months.
Yeah, absolutely. We have a proposed question, which I think is certainly relevant about the US dollar. So there's been a lot of headlines about the stability of the US dollar as the reserve currency and what that could mean. Do you have any thoughts as it relates to the dollar serving as the world reserve?
Yeah, well, the dollar's been incredibly strong, and there's lots of drivers of currency moves, but the primary fundamental driver of what the dollar does or any other currency globally and relationships between currencies is a function of interest rate differentials. So when you're in an environment like we are right now, where longer term interest rates have been going up, the Fed has paused rate cuts, while at the same time, many other central banks around the world are cutting rates. That widens the interest rate differential, higher yields in the US, lower elsewhere. That puts upward pressure on the dollar and leads to buying of the US dollar. So that's been the primary reason why we've had strength in the dollar. Plus, our economic backdrop is healthier than a good chunk of the rest of the world. As to the question of, is the dollar going to lose its reserve status? The short definitive answer is absolutely not. I actually always find it interesting when I get this question, and I'll often pose a question back. Okay, if you're in that camp that believes the dollar is going to lose its reserve status, who will take its place, or what currency will take its place? And that's where you tend to get people somewhat stumped. For a while there, I would often get the euro, but that was in the early days of the euro when people assumed it was going to be this uber powerful currency because it represented the entire European bloc, which as an economic bloc is actually bigger than the United States. But that sort of forgets the idea that it's a single currency. And I can't remember whether it's 16 countries or 17 countries in the euro. It doesn't matter, but it's either 16 or 17 individual bond markets. They didn't blend all the bond markets into one. So there really is practically no way the euro could replace the dollar as the world's reserve currency because there's not enough liquidity in any individual bond market. And given how much global trade is still done in dollars, it's about 80% in dollars representing one side or both of any transaction. The recipient of those dollars in global trade have to put those dollars somewhere. They're going to go in US treasuries because there's no other bond market around the world that has that kind of safety and liquidity. Every once in a while, maybe more so recently, I get the answer crypto is going to replace the dollar as the world's reserve currency. Well, it's not really a currency. It doesn't fit any of the definitions of a currency. So no, Bitcoin is not going to replace the US dollar as the world's reserve currency. I I guarantee that. Regardless of your views on crypto, it's not the Chinese yuan. It's a non-convertible currency. It represents about 2% of global trade, and the list goes on and on. So don't lose sleep over the loss of reserve currency status. I think we eventually will get to a point where there are more than one reserve currency, but the dollar as the key reserve currency, as well as the global monetary standard, I think in my lifetime, that's not changing.
Yeah, that's good. That's such a great answer. Okay, let's move from the economy to the market. So we're just kicking off earnings season. So please, you kind of talked about the government, corporations, individuals. So looking at corporations, share your outlook for corporate earnings and profit margins and your thoughts on valuations.
Sure. So we are just starting earnings season. As is typical, it starts with many of the financial companies. And I think as of the close today, we only have 30 some odd stocks that have reported out of the 500 stocks in the S&P 500. So it's very early in reporting season. That said, so far so good. Earnings have been better than expected. What's called the blended growth rate, which when you're in earnings season, that blended growth rate means it's the companies that have already reported their actual earnings that are in the books, combined with the consensus estimates for the companies that have yet to report. So during reporting season, that blended growth estimate is sort of a moving target. It changes every day because you add more actual numbers in and you have fewer consensus estimates, such that at the end of reporting season, it's all actual numbers and you have an actual growth rate. But the estimate right now, the blended estimate for fourth quarter, is about 10.5% growth for the S&P 500. So that has improved from before earnings season began. However, it's been deteriorating over the past 3 months. So in the beginning of October, just before we started to get third quarter earnings reports, the expectation for fourth quarter was about 13%. Then that dropped to only about 9% before earnings season began. Now it's up to 10 and change. So we're moving in the right direction. And when you talk about earnings, it makes me always want to remember to share an adage that I share often, which is, whether it's earnings, whether it's an economic report, whether it's a jobs report, it's human nature for us to think, was it good or was it bad? Was it strong or was it weak? And kind of those level terms. But when it comes to the relationship between economic data or earnings data, and then what happens in the stock market, better or worse often matters more than good or bad. So it's where is the expectations bar and what are the numbers relative to that expectation bar? That tends to be more market moving than just the level. It's easy to say, well, 10% earnings growth is great. But if the expectation was for 15% and you're only reporting 10%, market's not going to like that. So it's the rate of change versus level analysis. I'd say where there may be a little bit more concern is for calendar year 2025. Right now, the expectation is there to be about 14% earnings growth in calendar year 2025. Were that to happen, it means that profit margins hit a record high. That may be a little bit of a stretch. I don't anticipate a weak earnings year, but that maybe not a stretch, but that part of my job is to assess risks in a landscape of probabilities and expectations. That would be a potential risk, is if there starts to be some downward pressure on profit margins. And that could come into play if when we have more clarity on both tariffs and immigration, because both of those feed into that profit margin story. So we'll see.
Time will tell. We always are preaching to clients that quality is more important than sectors, especially when we're getting questions about what sectors do you like or sector-based ETFs. So can you tell us your view on sector-based investing as opposed to quality or factor-based investing?
Sure.
And maybe what factor-based investing
Yeah, will do. And I love this question. So sometimes it's on the part of the media, it's almost, I'm trying to think of a better word than laziness, but it's sort of a common thread of questions when I do, CNBC or Bloomberg is, what sectors do you like? It's kind of one of those natural questions that people ask or people want the answer to. And the concern we have in this type of market environment, market backdrop, is that that's akin to sort of monolithic decision making, saying, and we do have sector ratings at Schwab. We have outperform, market perform, and underperform ratings. And we do have one of those three attached to all 11 sectors. But to say outperform on communication services or financials, which happen to be the two sectors on which we have outperform ratings, that doesn't suggest and shouldn't suggest that every stock within communication services is going to do well. Every stock within financials is going to do well. And that's why we think, at least as an add-on, if not as a separate exercise, invest or screen based on factors. And you asked the question about what are those? It's really just another word for characteristics. So you mentioned quality. That can be considered a very broad individual factor, but if you go down to a more granular level, there are a lot of factors or characteristics that sit under the umbrella of quality. So examples would be strength of balance sheet, companies that have high interest coverage. They're not at the mercy of changes in interest rates. If interest rates go up, they have plenty of cash to cover interest payments, so that is not going to be a killer for them. Positive earnings revisions. So even in a more constrained economic environment, these are companies that can continue to grow their earnings. High cash levels. I already talked about the benefits that accrued to companies with a lot of cash that have been actually earning more interest on their cash than they're paying interest on their debt. Strong free cash flow yield. Then you can get into valuation type factors, making sure you're not paying really rich valuations for stocks. And there's a lot more access to factor data screening tools. There's a lot more firms out there that are managing money with that factor orientation. And part of the reason for that is that, and I think this will be a somewhat secular phenomenon, is if you look at performance rankings at the sector level, and we have an interesting visual that we show that is just a ranking on a month-to-month basis of all 11 sectors, and each sector is color-coded. It's like one of those typical asset class quilt charts that probably many people have seen, but we do it at the sector level and we do it month by month. And over the past year, you can look at the far right and see the ranking over the full year, and communication services was the best performing sector. Technology was the second performing sector. But if you looked month to month, those two were all over the map, often going from top of the leaderboard to bottom of the leaderboard, back to the top. And that makes it a little bit trickier and harder to sort of stomach some of that volatility, whereas there's been more consistency in performance at the factor level. So for you to look at how stocks that screen well on free cash flow or stocks with the highest interest coverage or the best earnings profiles, much more consistency in performance at that level than at the monolithic sector level.
What about the Magnificent Seven? Do you think that the enthusiasm around this group of stocks is likely to continue in 2025?
It is fading a little bit, but not dying on the vine by any means. You've had a couple of sort of pullback phases for that group, and maybe one should expand it to sort of the mega cap tech and tech related names. Magnificent Seven has sort of become this proxy group of 7 stocks, but we're really talking about the mega cap high growth stocks. And you did have a pullback phase from mid-July and until early August, and then you had some choppiness. Then you had another kind of surge in the somewhat immediate aftermath of the election, but then we've seen a little bit more choppy action recently. So I think that there's just maybe not the sort of straight shot up. But here's a really important message, though, as it relates to a grouping like the Magnificent Seven. A couple important messages. One, they're not all tech stocks. Among those 7 stocks, 2 of them are in communication services, 2 of them are in consumer discretionary, and the rest are in the technology sector. So they actually are represented by 3 out of 11 sectors. They often get thought of as, oh, they're the big high-flying tech stocks. They're also not the best performers. So the attention given to them is a function of their size and the fact that they have been dominant contributors to capitalization weighted index performance, like the S&P 500. So they're driving a lot of the gains in the S&P, but in many cases, it's more a function of their size than it is their price performance because the contribution component comes from multiplying the price move by the size equals contribution. And another way, and maybe an easy way to think about that, is if you look over the past year at the 10 best performing stocks in the S&P 500, only one of them is in the Magnificent Seven. Maybe no surprise, it's NVIDIA. But NVIDIA is not the first. The top performing stock in the S&P 500 over the past year is a utility stock. It's Vistra Energy. 4 of the top 10 are in the industrials sector. There's another utilities in the top 10. United Airlines is in the top 10. So the message for individual investors is you don't have to be as concentrated in those stocks as what they represent in the S&P. That might be an institutional problem. If you're running a big fund and you are benchmarked against the S&P 500 on a quarterly basis, you are at the mercy of what size they represent in the indexes. And if you don't own similar size, unless you are nailing every other great performing stock, you are at the risk of underperforming the benchmark. That's not an individual investor problem. In fact, if you look at the past year at the top 10 best performers in the NASDAQ, none of them are in the Magnificent Seven. None are large cap stocks. None of them are household names. So that's my kind of public service announcement for individual investors as it relates to the hype associated with some of those names. Great, they're all great companies. Just be mindful of not letting that cause you to get overly concentrated in your own portfolio. That's our message.
Do you think that we'll continue to see a broadening out in the market?
With fits and starts. And kind of similar to what we saw, particularly in the second half of last year, we did start to see some broadening out for a period of time from that midsummer on. For a few months, you had the equal weight version of the S&P outperforming the cap weight version. Small caps started to do well relative to larger caps, but then that kind of faltered. A lot of people tied it to the election. I don't think it really had to do with the election. It had to do with the point the Fed shifted from being in sort of easy mode, cutting interest rates, to we're gonna back away from that. And in turn, the 10-year yield going from the low fours to the high fours. And I think that put a lot more pressure on small caps. They're more at the mercy of changes in yields. They have more variable rate debt. That meant that equal weight started to underperform. I think we're going to get bouts again of small caps finding some legs and equal weight, but I think it's going to be in fits and starts. I don't think we can sort of draw a line and say, now it's going to all be about equal weight. It's going to all be about small caps. I think these rotations, whether it's at the cap level or growth versus value or at the sector level, I think these fierce rotations are likely to continue.
What about volatility? We've been in a market with historically low volatility. We've seen volatility start to pick up, and we're always trying to remind clients that it's not normal to be annualizing, getting 20% plus a year on portfolios and kind of just tempering expectations. So what are your thoughts on volatility on a go forward basis? Do you think because of the amount of cash on the sidelines, any kind of dip is short lived and more money goes into the equity markets?
Well, it is interesting because until somewhat recently, volatility in the equity market has been pretty subdued. It's been relatively low for a pretty extended period of time. And that is surprising to a lot of investors, given just how many uncertainties there are in this environment, whether it's geopolitical or monetary policy uncertainty, inflation uncertainty, government policy uncertainty. I mean, the list goes on, and one would expect to see more equity market volatility given that backdrop. But the real answer is there has been a ton of volatility It's just been housed more in the bond market than it has been in the equity market. So the VIX, the volatility index, is the most common index used to track equity market volatility. And that is the index that has been fairly subdued. But there's also an index called the MOVE. MOVE is the symbol, and that's similar to the VIX, but it's on the bond market side of things. That has been very, very elevated historically for a pretty extended period of time. So it's false to say there's been no volatility. It's just in this cycle, it's lived more in the world of the bond market than it has in the equity market. Now it's fed into equity market fluctuations up and down. It just hasn't manifested itself in that spike in traditional measures of volatility. But be really careful because there's a lot of products these days that are coming back out, kind of betting that equity market volatility is going to stay low and that returns are going to stay as high as they've been in the last couple of years. I'm not a Debbie Downer. I'm not wearing some, bear market hat on my head, but we do think you want to be realistic about the likelihood of another incredibly stellar year given what we've already seen in the market. I think we want to just be careful about extrapolating what has been two fabulous years in perpetuity into the future.
In light of earnings season, I think we'll see a lot from banks as it relates to the health of the consumer. But what do you see as it relates to spending, saving, debt, and what that looks like? As we know, consumer personal spending makes up so much of GDP. Yep. So what are your thoughts as it relates to the health of the consumer?
Yeah, so consumer spending is about 68% of GDP. And for the most part, it's been quite healthy through this period. And it sort of belies some of the historical relationships that tie into consumption and whether it's strong or weak, including the savings rate. And the traditional savings rate has come down to, 3 to 4%, which is below-ish longer-term trends. It's not dire by any means, but it's well down from the pandemic peak of short-term peak of over 30% when we were in stimulus mode. Then there's this other concept that's more relevant in this post-pandemic environment of excess savings, driven by all of that massive stimulus that came in and how much of that has been worked off. For the most part, that has been worked off. There is still some excess savings up the income spectrum among the wealthier. They're also, for the most part, the asset owners. So you still have, ample net worth gains on the upper end of the income spectrum. The correlation, though, between the highest income folks and their net worth and consumption is well lower than kind of the middle of the distribution. It's the middle of the distribution, call it the middle class, that has the strongest relationship between net worth and consumption. So that's really the bucket to watch. I think, though, leaving aside metrics like savings, what has been most beneficial to keeping consumption in healthy territory has been strength in the labor market. Again, it's my job to assess risks, not just talk about opportunities. Is a risk? It's this is not my base case by any means. Is if we were to see faltering in the labor market, weaker payrolls numbers, or rising unemployment rate. At this stage, given the drawdown that has happened in savings, that could start to feed into weaker consumption patterns. So I think it's the strength in the labor market that is sort of that strongest pillar under consumption, but also one worth watching.
Yeah, good point. And certainly at 4.2% on Friday, I think at least we're safe for the moment.
Yeah, actually it went from 4.2 to 4.1. So it's pretty rare for the unemployment rate to start moving up and then reverse. Now, we don't know whether this reversal is the beginning of more reversal, more move down, but it could be yet another thing that makes this cycle very different from past cycles.
Well, Lizanne, we're always so grateful for your time. I think we've gone through all of the client questions submitted. So I always like to end just to ask you, what do you think are the most important takeaways for investors in this environment or just in general? Any words of wisdom before we close?
I would love to answer more in general as opposed to kind of takeaways from our discussion. And maybe this is going to sound odd, but one of the takeaways is a lot of what we talked about doesn't really matter. And what I mean by that is a lot of the short term and the focus on what the Fed's going to do at the next meeting and what earnings growth rates are going to be, and trying to assess what they're going to look like down the road. um, it doesn't really matter. One of the things I always like to say is not what we know that matters, meaning about what's going to happen to economic data, what the Fed's going to do, what the market is going to do. It's not what we know that matters because we don't know. It's the unknowable. It's what we do along the way. So it's those tried and true disciplines that matter to our success. One of the most common questions I get from the media, especially when it's a more tumultuous market environment, is, okay, Lizanne, are you telling your clients to get in or get out? And I always just silently shake my head to that because I think it's sort of a silly question, because neither get in nor get out as an investing strategy. It's just gambling on not just on one moment in time, but on two moments in time. And investing should be a disciplined process over time, never about gambling on any moment in time. And, CNBC is not going to want me or anybody else to come on and talk about the benefits of diversification across and within asset classes and the benefits of periodic rebalancing and taking a factor-based approach, more, ho hum. But that's the stuff that actually matters, as you well know.
That's not the sexy things that they want
Right.
you to say.
But
Well,
it's the real stuff. It's what matters.
well, Lizzie, and thank you. You are amazing, and Schwab's been such a great partner to us and for our clients, and to all of those that joined us today. Thank you for your time. Again, this replay will be on our website, evansmay.com, through the end of January. So without Lizzie, and thank you again, and thank you
My
for
pleasure.
who joined us today.
Thank
Have
you.
a good evening.